Interest rates are to valuations, what gravity is to the apple. We can all say we don't do macro, we ignore the backdrop, but we can only say that because most investors have only been investing during a period of really low rates. So when you have low and stable rates, right, you've never had to think about it. But trust me, if you were investing in 1978 or 1982, you thought a lot about it, right? And in particular, the rate of change of rates is super impactful, particularly when we're talking about long duration, high growth assets. And so to me, you have to accept that. You should have had a margin of safety baked into the cake when you made the original investment. If you made the mistake and you didn't, you have to be sober today. What is the multiple that's going to get paid at exit? Everybody on my team, for example, knows that we're applying a 20% discount to the pre-COVID 10-year average, right? So that is the exit multiple that we use. So now we have to say, let's assume everything goes right. Let's give the entrepreneur the benefit of the doubt. This is a super cycle, a company we love. We want to be investors. So let's assume all of that, but apply a rational multiple to that. Do we get a target return, right, that's worth us writing the check? And oftentimes, listen, these $1 billion, $2 billion, $3 billion software rounds that are done with very little revenue, you have to assume a tremendous amount goes right. And then you probably have to assume an absurd multiple. And everybody's counting on the greater fool, right? And you just there's going to be a lot of money that gets lost in all of those rounds. And so I don't particularly care if it's full of all the great investors or anything else. We do our own work. I don't carry the bags for anybody. We do our own work, and we're going to force ourselves through that screen around valuation.
There's a couple of points I have to pick up on. You said about the rate of change there of interest rates being so important. Talk to me, how does the rate of change of interest rates impact our job so profoundly?
So if you think about it, in 2000, 2001, 2002, rates were at 6 or 7%. And there was a tremendous amount of value creation between 2000 and 2005, right? Because we had this massive secular tailwind in the internet. But the rate was fairly stable during this period of time and was moving, the market believed, directionally lower, okay? When you have a period where we just went through something that is a major standard deviation event, which is going from basically 50 basis points to 400 basis points on the 10-year, it leads to a state of paralysis. Because our job is to predict the future. We got to forecast the future for the company, but we also have to forecast what is the multiple the world's going to be willing to pay at a point in time in the future. And so I think when people see a huge rate of change, now we have Larry Summers saying we may go to 6 or 7%. Well, your cost of capital is going up. You need to have some predictability about that cost of capital. Let me take it to its logical extreme, Harry. Let me tell you that you could earn 20% a year in a risk-free investment. Okay? How many fewer investments would you make?
Many.
You would make 90% fewer investments. Okay? Because the hurdle rate to that capital now gets so profoundly different. This is why interest rates do have the impact they do. It really matters, right? And so once you go to logical extreme, it becomes very obvious. We would all just go surf and ski and hang out and do the fun things we do because you would double your money every 4 years. You wouldn't do this at all. That's a higher rate of return than the 70th percentile in venture. And it's risk-free. So, obviously that matters. We spend a lot of time thinking about it, but we don't try to out-forecast the best macro people in the world. What we effectively do is we look at the futures strip. And we say, what is the market telling us that future rates are going to be? So right now, the market's saying Fed funds rate will peak out in March of next year, something like 4.5%. We don't try to outsmart the market. We just say, okay, let's use that as kind of a rule of thumb. There was one period of time, October of last year, where I went on CNBC and I said, I think that the market could very well be getting it wrong. And if once COVID normalizes, I expect us to go back to January 2020 levels on interest rates. And if we do that, then multiples on the NASDAQ will be down 20 to 30%, which means the NASDAQ will be down 20 to 30%. Now, I wish I had followed that wisdom as well as I articulated it. But the reality is nobody should be surprised. In fact, in some ways, we should be celebrating. You know what this means, what rates mean today? It means that humanity beat a global pandemic that in March of 2020, we thought might wipe out 20% of the world's population. That's what this means, right? So I suspect that the new normal is going to look a lot like the old normal, but we have to get through this period of massive uncertainty and volatility so that you and I can underwrite to a predictable cost of capital.
I think it was Chamath on the panel that you and Gurley and J. Callan Sachs did together, who said you would never be investing in this period of uncertainty with valuations being so transient and fluid because it's almost irresponsible to invest in a time when no one knows where valuations are going to rest. And then I'm like, listen to Gurley, and Gurley says, no, the best investors invest continuously, and you're always investing, and you're always in market. And I'm going, I'm a student of venture, Brad. Which one of these incredibly smart people do I believe?
I mean, well, come on. If it's Gurley versus Chamath, you know which way you got to go.
Well, that's bloody true.
I mean, just put it out there. No, they're both brilliant. And here's what I would say on that. Our strategy has always been, we're not going to say all or none. As a firm, we say less or more. Okay? So your aperture should be expanding and contracting based upon what you see going on in the world. So if multiples are at an all-time high, like they were last October, and when I went on All In and CNBC, we showed the charts, etc. We talked about the things we were concerned about. If multiples are at an all-time high, your aperture should be contracting. That doesn't mean you shouldn't do any deals, but you should be really clear that you're only doing the best deals because only the best deals will clear those valuation hurdles. At the same time, when the world's panicked, when there's blood in the streets, as Buffett says, I agree with Gurley, your aperture should be expanding. But let's be clear about where we are today, okay? This is not a blood in the streets moment. It feels catastrophic because we have growth names that are down 40, 50, 60, 70% in the public markets. But look at where they are compared to where we were in January of 2020. For most of these companies, it's just getting back to the normal or slightly below normal or average valuations. That's how far in left field we were in terms of valuations, right? So don't anchor yourself to the stupidity of the last 18 months. Do a de novo underwriting based upon the facts as they exist today. So for Altimeter, listen, we just signed a Series A deal. We have a Series B term sheet out. I still think that valuations are full. I think valuations in venture in CD&E are still overvalued. So we have a lot of work to do. But the secular curve around value creation and disruption, all data moving to the cloud, ML and AI applications like that, there will be more value created over the next 10 years than over the last 10 years. But price of entry matters.